Welcome to the Gray Report, a special live edition. Thank you for taking your time this Friday afternoon. Special guest host Blake Pieroni, who's the head of investor relations here at Gray Capital, joining us today to talk through some of the bigger issues in the multifamily industry. But even more exciting than that, talking about the experience that he's just gone through. I've just gone through something that we do all the time here at Gray Capital, and that is raising capital for multifamily investors from family offices, high net worth individuals, and even institutions. Blake is incredible at what he does. He's a key member here, a team member at Gray Capital. And he's also got a really interesting backstory. He's got maybe a couple gold medals. He's swam a couple times, although he would tell you he's not a swimmer anymore. And frankly, it's not necessarily, not that you don't like talking about it, Blake,
No, it's not that
but it's oftentimes it's a distraction from talking about multifamily.
Yeah.
Right.
Yeah, exactly.
But thanks for coming back on the show.
Yeah. Thanks for having me.
You're not a stranger to this room.
No.
A lot of investors at Gray Capital seen you through this lens. Because if you're a prospective Gray Capital investor, you schedule a meeting with us. If this room is available, it's kind of like the best room to have a video call. And so a lot of our investors, prospects see you and Griffin or me or anybody on the team kind of from this vantage point.
Yes.
So, but you haven't been on the Gray Report podcast in a while.
I have not.
So just taking a step back from your vantage point, we'll start really high level. I want to get into some of the news and reports, and then get into some of more of your experience. But skipping ahead a little bit, I'm just curious of what you're taking a temperature on how you feel up on the multifamily market right now.
Temperature check for multifamily. I think it's such a mixed bag. You can't do one temperature across the board.
Yeah.
I think like real estate's always been hyper local, but I think even more so now it's like extremely local. Like a lot of the markets in the Midwest, like Indianapolis or Columbus, we're like super bullish on. Like valuations are down. We think now's the time to buy. And there's some other markets that, we wouldn't even look at deals there. They paid us to buy them. It's just such a mixed bag because, investors are kind of wishy-washy and a lot of uncertainty from them. A lot of debt questions, negative rent growth in some areas, positive in some others.
Yeah.
Expenses, some like actually insurance maybe coming back a little bit, property taxes still going up, but insurance already had like a big run up and now it's pulling back a little bit. I don't know. It's just like it's a wishy-washy market in general.
Confusing.
Yeah.
And that probably goes to, it's also true for the broader market, not just multifamily. If we zoom out a little bit, talking to just anybody, it's hard to make sense of where we are with tariffs, uncertainty, geopolitics.
Yeah.
It's an interesting point. Potentially interest rates are going to be coming down in September. But you mentioned markets, and it's so true. And it was the good answer because every market's different. Every submarket is different. And when we're telling the story of like an Austin, Texas versus a Columbus, Ohio, or a San Francisco, they couldn't be more different. So getting to RealPage, this report that came out, it was interesting. This was the most clicked article on the Gray Report newsletter, which you can go sign up at graycapitalllc.com. I think it's the best multifamily newsletter that's out there. But it's 10 U.S. apartment markets set to see deliveries increase next year. We've seen so many articles about how supply is getting ready to fall off a cliff.
Yeah.
Again, if you just look at the national numbers, that's true, and in many markets it is. But there are some markets that are still adding supply. So, we're looking at this chart right here. This is the U.S. national, annual apartment supply scheduled to drop off. It already started dropping off kind of end of last year of 24. We've seen markets like Indianapolis. There's almost like a 50% year over year decrease in potential new apartment supply coming online. But then there's some markets.
Can I tell you the one that surprises me?
Yeah. So we're looking at this list.
Yeah.
Looking at and some people are watching on YouTube. Well, everyone's watching on YouTube right now. Later, there's going to be some folks that'll be listening on the podcast. So yeah, what on this chart, what on this list surprises you?
I would say Cincinnati.
Yeah.
Yeah.
And so Cincinnati is, number 1, 2, 3, 4, 5 on the list. They are seeing a 47.4% annual supply increase. And now that's year over year increase. So it's not like there's going to be, 50% more apartments in Cincinnati. They're just building 50% more than they delivered last year. And so they basically delivered about 2,100 in 25, or that's supply for year end at the second quarter of 25. They're scheduled to complete by the second quarter of 2026, 3,100 apartment units, increasing that count by basically 1,000 year over year. And part of that could just be kind of the local timing of that. Maybe there was a supply. We'd have to drill down into Cincinnati to
Tougher
see if
permitting?
could have been tougher permitting, or maybe that there was a slightly lack of supply, in 2023, and then it's just a little bit of a delay,
a little bit of a lag
when those units came online. And that's, again, it's a great example of every market tells a little bit of a different story. I mean, Los Angeles, and you brought this up before we press play. I mean, Los Angeles is seeing a 93, almost 94% increase from last year, going from 8,000 last year to 8,000 this year to projected 15,000 next year. But that's its own unique story. I mean, that has to be regulatory burdens, and other political issues in Los Angeles, a lack of capital. But that's a big number to post.
Yeah. Dallas has been the city that I have heard from more LPs in the past few months, where it's just the amount of supply that they're dumping into that market. I wonder if Los Angeles is going to be the Dallas next year.
Could be.
Where, GPs are getting crushed by a lot, super heavy negative rent growth in that market. Yeah. Interesting.
Yeah, and I'd have to look at what's not on this, which would be a helpful metric that we just don't have right in front of us right now, but just what that percentage of existing inventory is. Because Los Angeles is such
so
a big
big
market. And so 15,000 units is a lot of units, but for Los Angeles,
relative.
I don't necessarily think it's that many units compared to Los Angeles.
Right.
New York City, for example, is delivering 25,000 units.
Yeah.
And that's not a huge increase from last year, but it is increase from this year to next year. It's about a 1,200 unit increase. So to me, it has to be a regulatory shift, and somebody probably knows in the comments. They can drop it down in the chat or tell us later they've all figured it out. But we don't really pay attention to Los Angeles multifamily too closely. Also, Detroit's on the list. To me, I can understand that a little bit more, just because it's been lagging behind. A lot of investors are be a little scared of Detroit because there's some areas you probably don't want to invest in. You don't want to catch a falling knife, but there's also some really great growth stories around Detroit, some suburban Detroit opportunities. I think some urban Detroit opportunities, but you just have to be really specific on where in Detroit.
Yeah, hyper local. Yeah.
Hyper local. But if you talk to anybody that's in Detroit, they'll tell you all the really exciting things that are going on. San Diego, a lot of California, San Diego, Anaheim, mentioned Cincinnati. Fort Worth. Dallas isn't on this list, but Fort Worth is on this list. They're still adding supply. We were just at an investment conference this week in New York City. I'm talking to some, Dallas, focused investors and some Texas focused investors, and man, they are really hoping that supply.
They didn't
gets
read
absorbed.
This article.
Exactly. Again, you would hope to think. Even like Indianapolis, where we're not oversupplied to the extent that Dallas is and other markets, but we saw more supply than we've seen in a long time. And so when we see an article that, our deliveries are going to come down by 50%, that's got us feeling pretty good.
Yeah. And we saw some headwinds from the supply that we had.
Yeah.
Nothing.
For sure.
I just can't imagine, being a sponsor and focused in Dallas and Houston, Austin.
I can't imagine.
Can
you imagine? Again, our portfolio, not to
Did anyone project negative 4% rent growth on their performance?
You're active in our underwriting models. You know what negative rent growth does to pro forma. It ruins it.
Yeah.
But there's just no way you can get out ahead and get a positive real rate of return if you have negative revenue growth. Exactly. And your expenses are going up.
Exactly. I guess you could just have to hope you're more so in B class stuff, because hopefully a lot of the new supply is A, luxury A+, and maybe not competing with you as much.
I think that the hard part, though, is what we've seen is that it's trickled down to B class apartments also. I think that's one of the interesting phenomenon or facts that we've learned over this last couple of years is that new supply, even if it is Class A inventory, ends up trickling down to B and even C class, because especially when those A class units are competitive to be leased up, they're lowering the rents, they give concessions, and all of a sudden they're competitive compared to the B class properties. Right. I mean, an extreme example, it's not exactly a perfect analogy, but like what we experienced with Echo Park and Hayden.
Yeah.
Echo Park is kind of like an A minus. Hayden comes in, which this is Echo Park's one of our properties in Bloomington, Indiana, and then there's a competing property down the street that was brand new, really nice, basically a decade newer. And they lowered their rents to match our site. And so, like, how do you compete?
I guess if you were there was such a big gap where, if you were $500 cheaper, or everything coming in was $2,500 and you were at $1,800, maybe you would feel a little bit of confidence in that, to where hopefully most of it.
True.
But it's kind of, hope and a dream, I guess.
And I think that there is insulation when there's not so much inventory.
Right.
Because when there's like a few new properties coming online, they don't have to be as aggressive.
Yeah.
And so you can maintain the spread of your B-class apartment communities.
Right.
But when so much inventory comes online and no one can lease up anything, managers and owners get desperate and just because they're trying to lease up to get out of that construction loan as quickly as possible.
Yeah. If I was an LP and I saw a deal in any of these cities with any sort of moderate rent growth, I would, heavily question it.
Yeah. Yeah, I agree. Although, again, I think each one, there's just nuance to each one. I mean, I don't think just like year over year supply increase tells
at least in the first
story.
2 years.
Again, I'd want to see, relative to the existing inventory.
Yeah.
And just lining in where, and then certain submarkets are going to be different.
Yeah.
Like some markets on here that I like. I mean, I do like Cincinnati. Pittsburgh, I think, is an interesting market. We're not actively pursuing any deals in Pittsburgh, but it's got some interesting fundamentals. It has a lot of, I hear it more and more being like lumped into Midwest. Although when I think of Pittsburgh, it's like definitely like a Northeast, because it's in Pennsylvania, but it's obviously Western.
Yeah,
Western like part of Pennsylvania. And then a lot of these, I mean, are your kind of Northeast primary markets: New York, Boston. Newark, throw that in with New York, San Diego, Los Angeles.
Yeah.
So it'll be interesting.
And so while these are only 10, this article is saying all of the others are having decreases.
Yeah. Exactly. These are the outliers. Right. The rest of the market, I mean, this is the rest. This is the average or aggregate of the market right now.
Right.
As they are continuing to slide down. But